Hello everyone, welcome to Macroeconomics. Today's session is going to be regarding aggregate demand and aggregate supply, the economic model of aggregate demand along with the characteristics of aggregate demand and aggregate supply. Let's get started with the session and thank you for joining. Aggregate demand is a way to view the economy as an economic framework that is used to analyze the collective behavior of the economy. So we use the aggregate demand and the aggregate supply, short ADAS, the ADAS model, as an economic analysis to study economic activity from the demand side on the aggregate level and on the aggregate supply side, in this case from the production of goods and services in the economy. And the framework of the analysis has three different parts. The aggregate demand, in this case, from all of the aggregate consumption, investment, government, and foreign sector. The short-run aggregate supply of production of goods and services. The short term could be a quarter, half the year itself, or depending on how we look at the short-run aggregate supply of goods, and the long-run aggregate production of goods and services, in this case in the economy. The long run can consist of a year, 2 years, 3 years, 5 years, the long-term frame. And we analyze aggregate demand and aggregate supply in terms of the collective production and consumption of goods and services produced in an economy within a given year or within a given time frame, known as gross domestic product. Let's take a look forward by looking at the economy. So an economy is consisting of several structures. We have a simple economy that has the buy-in side, all of the buy-in sectors, which is the aggregate demand, AD, aggregate demand, all of the buy-in sectors of an economy. And then we have the production sector, which is on the aggregate supply side, which produces goods and services in the short term, which is the short-run aggregate supply, and produces goods and services in the long run, which is the long-run aggregate supply curve. So we have the production side on the production area, and then we have the consumption buy-in side on the aggregate demand side. Both of them meet together in the economy, buyers and sellers, aggregate supply, aggregate demand, to interact for mutual exchanges in a market economy. Now, to start with aggregate demand, it's the quantity demanded for all goods and services measured by real gross domestic product at different price levels. So as consumers, as members of the economy, we demand a lot of goods and services. And there's different prices for goods and services. And aggregate demand, unlike just the demand for goods, is the collective demand for all goods and services in the economy at different prices. And suppose we have here different quantity of goods and services that are demanded in terms of real GDP. So the quantity demanded here will be the real GDP demanded of goods and services for a particular period in the economy at the given price index. So the price level here will be an index price at which we demand goods and services, which is commonly referred to as the CPI, the Consumer Price Index. So you have the Consumer Price Index here at 100, 110, 120, and the aggregate demand for goods and services at a lower price index is 1,200 billion. At a higher price index, it's lower at 1 billion, and if the price level increases, we have even less aggregate demand for goods and services at 800 billion. So it still has an inverse relationship here, but the aggregate demand curve is a little bit more has a collective analysis in terms of how the market behaves. So in this case, the aggregate demand curve is a graphical illustration of a curve that shows the quantity of all goods and services demanded in terms of real GDP at different price levels. To be more specific, at different price index levels, and given the relationship. And the aggregate demand is for the collective goods and services that are demanded by all sectors of the economy, not just consumers, but all sectors. This is what differentiates aggregate demand with just the regular demand for goods. Aggregate demand is the collective aggregate demand for all goods and services by all sectors of the economy. And we're going to see what those sectors are. Now, at the very basic level, we have the graphical illustration, the price index or the price level on the vertical axis, the real GDP on the horizontal axis. I'm going to refer to real GDP here, more specifically, consistently as real GDP, just so that we don't confuse this with the traditional law of demand, which is just quantity and price. At price level 1, the real GDP demanded is real GDP 1. At a price level 2, if the price level drops, the real GDP demanded is Q2. So we have an inverse relationship here. The aggregate demand curve shows the price level and the quantity of real GDP that are demanded at in a specific price level, and the inverse relationship between those. The higher the price level, the lower the real GDP demanded. The lower the price level, the higher the real GDP demanded, and vice versa. So we have a simple downward sloping aggregate demand curve that expresses the relationship between the price level of all goods and services measured by real GDP and the quantity of real GDP consumed at that price level, and vice versa. Now, when we're looking at aggregate demand, the aggregate demand slopes downwards not just because of the price level relationship that it has with the consumer price index, but also because we have what is called a purchasing power effect. The purchasing power has a relationship with the price level. They're inversely related. The lower the price level, the greater the purchasing power of goods and services. And as the price level rises, or as the price level goes up, the purchasing power goes down. So it further elaborates why aggregate demand curve is downward sloping. We have the purchasing power effect. Higher price level reduces purchasing power. So you demand less units consumed, which is measured by real GDP. The lower the price level, the greater the purchasing power and the greater the quantity consumed. The second point why the aggregate demand curve is downward sloping has to do with the interest rate effect. The interest rate effect specifies that the changes in household and there's changes in household and business buying abilities as the interest rate changes, which is an additional factor as to why the aggregate demand curve could be downward sloping. With lower interest rates, the consumer may increase their consumption of goods and services and buy more goods. So we have the changes in household and business buying as the interest rate changes is one of the other reasons why the aggregate demand curve is downward sloping. The third reason why the aggregate demand curve is downward sloping is the international trade effect. And the international trade effect specifies that there's a foreign sector spending that takes place as the price level changes. The international trade effect, it's more specifically to as the price level drops, in this case, goods become less expensive, and it increases the quantity of real GDP purchase, and it increases the units due to the units consumed due to the lower price condition, the change in foreign sector spending as the price level changes as well. So three main reasons why the aggregate demand curve is downward sloping: the purchasing power effect, the interest rate effect, and the international trade effect. And we can elaborate those later on or further on. Now, aggregate demand in this case with the real balance effect, it further explains the purchasing power effect. The real balance effect is the change in the purchasing power of dollar-denominated assets that result from a change in price. When the price changes, there's a balancing effect. It balances off the purchasing ability of the person. So the change in the purchasing power of dollar-denominated assets that result from a change in the price level has a real balance effect in terms of the consumption of goods. And the monetary wealth, it illustrates the value of a person's monetary assets. Wealth, it's a distinguished form of monetary wealth that is attributed to different sources. The amount of actual assets that are held by the person, financial assets, physical assets, tangible assets, and is the value of essentially all monetary and non-monetary assets that are held by a person. The wealth of a person is built over time. The wealth of a person is built over time, and that can help stimulate consumption, stimulate aggregate demand when it comes to the aggregate demand of goods and services in the market, collectively speaking, for all goods and services. The greater the wealth, the greater the consumption, the greater the spending, and the greater the investment, and so on. So it's important for aggregate demand purposes. The real balance effect here specifies that when there is a change in the price level, there is a change in the purchasing power of dollar-denominated assets that may be affected. So in this case, to let me clarify on the real balance effect, when the price level drops, any asset that is quoted in the price level may be affected. It can either decrease in value, or it can increase in value if the price of that product increases. When we're looking at the real balancing effect of monetary denominated assets. If the price level increases, the asset may increase in value. If the price level drops, the asset may decrease in value, and so is for physical assets and tangible assets as well. And that could affect the wealth of a person if you have financial assets or physical assets that are being affected when there's a real balancing effect. So the person's net wealth essentially is your net worth. What are your really net worth? What's your real net worth? Is your monetary wealth, all of your financial monetary wealth, plus non-monetary assets. Anything that is acquired as capital, plant and equipment, land, resources, economic factors of production, and so on. Non-monetary assets. These are all the tangible machinery, plant and equipment, and your monetary wealth will give you your net wealth. And if you want to, in your net monetary wealth here, to be specific, these are your income, your earnings, and so on. And any non-monetary assets are machinery, plant and equipment, and other assets that are owned by the person. Aggregate demand continue. The aggregate demand can shift. It can increase or decrease for various reasons. There could be an increase in aggregate demand, a decline in aggregate demand in the economy, and that changes also the real GDP demanded in terms of quantity, and also by shifting the aggregate demand curve, the real GDP can increase or decrease depending on the direction of aggregate demand and where it's shifting to. If the aggregate demand curve shifts, the quantity demanded of real GDP changes, even though the price could be sticky, could remain the same, could not change, or stays fixed for a certain period of time. The real GDP can increase or it can decrease if the curve shifts. And the shifts in the aggregate demand curve change when the spending on all goods and services changes. If spending goes up, aggregate demand increases. If spending goes down, aggregate demand decreases. And real GDP will move in the direction of where the curve is going. If aggregate demand increases, spending increases, aggregate demand increases, real GDP may increase. If aggregate demand decreases, or if it shifts downward, real GDP will decrease. So when we're looking at shifts in aggregate demand, there's a change in consumer spending that may trigger a shift, a total shift in the aggregate demand curve. So an increase in spending at any given price level will increase aggregate demand. And if there's an increase in aggregate demand, that would increase GDP. If spending decreases at any given price level, aggregate demand will fall. It will shift. And that would decline real GDP. If there's a lot lower aggregate demand, then real GDP will decline, and vice versa. Let's continue analyzing this further. An increase in aggregate demand is a shift to the right. It's a complete shift of the aggregate demand curve. A decrease in aggregate demand is a shift downward or to the left, closer to the origin of the aggregate demand curve, and gross domestic product declines. If it goes to the left, it gets closer to zero, so there may be a decline in GDP if it's decreasing. If it's shifting to the right, or a complete shift in aggregate demand, it may be an increase in aggregate demand by the consumers spending more, and that increases real gross domestic product as well, so in the market. So the aggregate demand can shift to the right or to the left, and it will move gross domestic product in that direction. And the price could be sticky. Stickiness means that the price remains fixed for a short period of time, and later it may adjust. But in the short term, prices are sticky, meaning they're fixed for a short term. The change in the quantity demanded, change in aggregate quantity demanded, can be expressed by this model A, which indicates a change in the quantity demanded of real GDP from 6 units to 7 units in real GDP terms due to a change in the price level. This is the price level, it's price index. So if we lower the price level, if there's a decline in the price level from 180 at point A, we have 6 units of real GDP consumed, to 150, which is point B, there's an increase in the real GDP of units consumed at 7 units. That's you're going from A to B, and that is basically you're moving along the aggregate demand curve due to a decrease in the price level has increased the real GDP quantity consumed. The full shift in the aggregate demand curve is when the aggregate demand curve shifts to the right, it changes location, it shifts outward, or it can change inward. And if you look at the price level at 180, they have a price level of 180. It stays fixed, it stays sticky, it stays the same. You have an increase in aggregate demand shifts to the right, and at that price level, we have 6 units consumed in real GDP terms. And at that price level, with an increase in aggregate demand at point C, we have 6.5 units of real GDP consumed, and the price index level may stay fixed, sticky, for at least a short term. It's also the same at a price level of 150. If the price level of 150 indicates that we have 7 units of real GDP consumed, if there's an increase in aggregate demand, we'll shift to the right. The price index can stay the same. It's fixed. Prices are typically fixed in the short term, and they stay the same to point D, which it means that there's an increase, a higher demand for the product, and we have sticky prices, which leads to greater units demanded at 7.5. So that's the difference between the shift and the change along the aggregate demand curve, and then a shift that can shift it out or shift it inward. We are going to analyze what shifts this aggregate demand. What shifts the aggregate demand? A change in the price level index will only create a movement from A to B or B to A. Other factors can shift the curve entirely to the right or to the left. So what are those factors? The spending components that affect aggregate demand. What makes the curve shift, either outward or inward? What can create the curve, the actual line to shift to the right or to the left? Well, the aggregate demand consists of the total spending of goods and services in an economy. In this case, we have the U.S. economy. So we're going to derive the aggregate demand, the total expenditure on all goods and services, as the aggregate demand curve. And that is that comes from the consumers, consumption by households and the consumers, plus the investors that invest and spend in the economy, plus government spending on goods and services, plus the net exports that are consumed by the foreign sector or the imports that come into the country. Aggregate demand is going to be equivalent to all of the consumption by the consumers that we are demanding at the aggregate level, plus the investors' spending, plus the government expenditures, plus the net exports. The total expenditure on all goods and services is the aggregate demand for all of those sectors, from the consumer side, the households, the investors, government, and the foreign sector. And if consumption increases, government spending increases. If consumption increases, if investment increases, if government spending increases, and if we have an increase in net exports, there's an increase in the total expenditure on U.S. goods and services. And when there's an increase in the total expenditure on all U.S. goods and services, the aggregate demand for U.S. goods and services will increase. It's like a logistical pattern. Consumption increases, investment increases, government spending increases, net exports increase, which means there's more exports that are exported to the rest of the world. There's an increase on the total expenditure on U.S. goods or any economic goods that will increase the aggregate demand and shift it outward. If consumption decreases by households, if investment declines, if government spending declines, and net exports decline, that indicates that the total expenditure on U.S. goods and services is also declining. That the aggregate demand on all of the goods and services are declining from the consumers, from the investors, from the government, and from the foreign sector. So therefore, at any given price level, an increase in consumption, an increase in investment, an increase in government spending, an increase in net exports will increase aggregate demand. So they're all in sequential order. Consumption increases, investment increases, government spending increases, net export spending increases, the total spending in the U.S. economy increases, aggregate demand in the U.S. economy increases. If consumption decreases at any given price level, if investment decreases at any given price level, if government spending at any given price level decreases, and net exports at any given price level decreases, aggregate demand for all goods and services decline. That's not a good thing. This lower part, the lower bottom one, it's not a good thing because the economy with low aggregate demand can go into a crisis or a recession, a contraction in the economy. Aggregate demand is very important. Often cases, there could be changes in spending. Why is there more total spending in the market? Varies for various reasons. Aggregate demand rises only if total spending increases. And aggregate demand requires consumers to spend. An increase in aggregate demand requires consumers to spend, investors to spend, government spending to continue, and the foreign sector participation. And those various reasons here are the following. Total spending can increase for two reasons. A decline in prices can lead to an increase in the quantity demanded real GDP, which is a movement along the aggregate demand curve. The aggregate demand curve stays the same, the price level drops, and you demand more units given that lower price levels. And the second reason in this case is the change in some factor other than the price that leads to a shift in the aggregate demand curve. So basically all of those four factors, consumers, investors, government, and the foreign sector, can increase aggregate demand, can shift the aggregate demand. There's four reasons. So why is there more total spending? Well, within point number 2, there are four main reasons why aggregate demand can increase. Consumers, investors, government, the foreign sector can shift the aggregate demand curve. If there's a price level change, that would just create an increase in the quantity of real GDP demanded, which is a movement along the aggregate demand, but it would keep the aggregate demand stationary, the same. Think about aggregate demand in your local analysis as all of the consumers that go to the store. And if all of them rush to the store, the aggregate demand from everybody will be consumption, right? The consumption of goods and services by households, C. That's the collective aggregate demand by all of them. And if you are an individual, then you're just looking at the micro level, your own consumption. But the aggregate demand for everybody is if everybody rushes to the store at the aggregate level, the aggregate demand for shifts. So everybody's trying to buy the products. Kind of what happened during the pandemic. Everybody rushed to the store. Aggregate demand increases for all goods and services in the market, especially commodities and food. Other factors, some other factor other than price, led to a shift in aggregate demand that everything was gone. And the prices were relatively fixed. They don't change right away. They stay fixed for a short time, and then they change later when the economy adjusts. So aggregate demand and all of their components that shift or that can change the aggregate demand is consumption, investors, government, and the net exports. What's within consumption? Well, your wealth determines your consumption abilities and your income and your stability of life. And consumption is determined essentially by your wealth, your income, your earnings, your career, your income that you have from your employment, some level of interest rates for credit borrowing, and so on, and your income taxes, depending on how high your income taxes are. The investment is determined by the level of interest rates that it's in the market for investors to borrow funds. At lower interest rates, they can borrow more funds and increase their expected rate of return to invest in economic plant and equipment development, expectations about the future, and business taxes. Taxation affects the investment and also potential subsidies and government regulations. Net exports are determined by the foreign sector and the exchange rates. If we want to export more, our exchange rate has to be adjusted because people have to buy the products that we are producing and sell it somewhere else at an affordable price. So that means that your currency needs to lower its value, and vice versa. If you want to import, if you have strong currency, you import products from abroad because in the exchange rate market, you can buy more from the other sectors, and vice versa. The exchange rate is a crucial role. Exchange rate markets, it's the value of currency trading. How much can you trade currency? It can either have we can either have good exchange rates, low exchange rates, high exchange rates. And the appreciation of the currency determines also our purchasing power of the actual currency that we're looking at, the monetary value of the currency. If we have a strong currency, then we buy a lot of products from all over the world and we import more. And we have a depreciated currency, it's not worth a lot, it's worth relatively little. We won't typically import, we will export products. So the exchange rate and the appreciation and depreciation of the currency is important when it comes to the foreign sector capability of buying the goods or selling the goods, and also your purchasing power of your currency. So the depreciation of the currency is important. If your currency is depreciating, it won't facilitate trade that much. People won't really want to hold depreciated value currency. Typically, if you want to export products, you may need to have a depreciated currency in order to facilitate the exchange rate for other countries to buy your currency, to buy your goods, and sell them imports. For us, will be an export. For them, will be an import. But if you have a strong currency, the U.S. has a stable, strong currency, stable exchange rates, to tend to import a lot from other parts of the world. So the depreciation is a nation's currency that makes foreign goods more expensive and our goods more attractive to them. So our currency in the U.S. is relatively strong, you import a lot, and vice versa. So that's important as to why we continue having a trade deficit. We buy a lot. In often cases, money supply. The money supply plays a crucial role in transactions in the market. In the availability of the monetary-based availability in the market can determine the financial transactions that take place. Again, money by itself does not create real capital. When you use that money to create something in terms of an investment that generates a real tangible capital, then that's an economic investment. Financial investments are just financial investments that may not necessarily generate real tangible plant equipment. When they generate something, it's important to differentiate between economic investment and financial investment, because the money supply facilitates both. Could facilitate both the funding of and the creation of a product. So here we have aggregate demand, the factors that change or shift or move the aggregate demand to different locations. Aggregate demand can shift and change by the consumption of goods and services. What affects consumption? Wealth, the wealth of the public. Interest rates, think about credit card interest rates. If you have low interest rate on your credit card, you consume more. Your income taxes can affect your consumption and your net income. Expectation about the future. Investment. The investment is affected by the level of interest rates, the expectation of the futures, and business taxes. Government activity. What can cause government activity to change? Well, we have government policy actually. This could be analyzed later on in a different chapter, in a different discussion or a different factor, but government policy making essentially can increase or decrease aggregate demand. Expansionary government spending, contractionary government spending, and so on may increase or decrease aggregate demand. For now, if government increases its spending, it will increase aggregate demand. If government decreases its spending, it will decrease aggregate demand. It has to do with approved policy making, which it has its own chapter on within its very own. Exports and imports. What creates a change in exports and imports? Well, the foreign sector, the economic stability of the foreign sector. If the foreign sector is doing well and they're earning income, they're going to buy more products of us. And if the exchange rate is low or high, it can affect imports and exports. All of them may influence aggregate demand. If one of these changes, if we have more exports, it increases aggregate demand. If we have more government spending, it increases aggregate demand. And if we have more investment, it increases aggregate demand, and vice versa. If investment declines, aggregate demand declines. If government spending declines, aggregate demand declines. If exports decline, aggregate demand declines. And what happens when aggregate demand declines? Gross domestic product also declines, because it's part of the graphical illustration. In the production side, we have the aggregate supply of goods and services, which is from the production side. The aggregate supply is the quantity supply of all goods and services in terms of real GDP at different price index levels. And the aggregate supply is separated into the short-run aggregate supply, the curve that shows the quantity supply of all goods and services in real GDP terms at different price levels in the short run, and also when it comes to medium-run aggregate supply and long-run aggregate supply. For the most part, we're going to refer to the short-run aggregate supply consistently. Why is the short-run aggregate supply upward sloping? Most supply curves are upward sloping. Some of them are horizontal, some of them have relatively lower slopes, but for the most part, short-run aggregate supply tend to be upward sloping for two reasons. Sticky prices stay fixed for a short term, so the supply curve is horizontal and then begins to increase when price adjusts, and worker misperceptions and workers' abilities. Essentially, the supply curve is upward sloping in the economic model. There are sticky price mechanism and the worker misperception abilities, and also the other factors of the market. Now, the short-run aggregate supply curve here is illustrated as an upward sloping supply curve here. The supply curve is upward sloping, and we have a direct relationship with the price level, and also because of the price level, the input price level of goods and services. So we have the price level, which is P1 and P2. At P1, point A, the real GDP is Q1. With an increase in the price level, at point B, real GDP increases from Q1 to Q2. We have a movement from A to B, so the aggregate supply curve here is upward sloping. The supply curve and the price level are directly related. The real GDP in terms of quantity supply is directly related to the price level. So perhaps this is probably the best reason why the aggregate supply curve is upward sloping. It has a direct relationship with price level in the market for all goods and services. The higher the price level, the greater the quantity supply or real GDP terms. So we have an upward sloping supply curve that is upward sloping. And the aggregate supply curve can shift or it can contract for various reasons. The short-run aggregate supply curve can shift to a new location, and the factors that shift the short-run aggregate supply curve are as follows. The wage rate, potential wage rates can shift the supply curve, the aggregate supply curve in the short run to the right or to the left. Prices of non-labor inputs that are related in the production process. The productivity of goods. If there's greater productivity, the aggregate supply curve increases. If there's a decline in productivity, aggregate supply of goods will decline. Supply shocks. The supply shocks, economic supply shocks. These are things that happen in the economy that no one expects. There may be a drought that lowers the availability of harvest products. There's a shock in the economy, the supply of those products declines. There could be positive shocks, negative shocks. Negative shocks decline the total supply of goods. Positive shocks increase the supply of goods. Think about it with an earthquake. I like to think that here, a supply shock. Think about it of an earthquake. It will negatively affect the supply of goods and services, especially if it affects the production process of goods. Government regulations and subsidies can affect the total supply, the total aggregate supply of goods. Taxation also can affect the total aggregate supply of goods in the short term, at least during the time of the policy. The short run, again, it's 6 months, a year, or however we define the short term. Some people disagree. How long is the short term? How short is the short term? It really depends. Sometimes it's 6 months, a year, 2 years, 3 years. Then we get into medium run or long-term effects. The long run consists of short-term fluctuations, essentially. Think about the short run. I like to break down the year in 4 quarters. Quarter 1, quarter 2, quarter 3, quarter 4. Think about quarter 1 as a short term. Think about the entire year as the long run. And the supply curve can shift to the right or to the left for these various reasons. If the supply curve decreases, the supply curve shifts left. Here we have original curve SRSA, SRAS1, the short run aggregate supply curve. If you see the abbreviations, short run aggregate supply 1 is the starting point. If there is an increase in the wage rate as one of the shifters that shift the aggregate supply curve, if there's an increase in wage rates on the aggregate supply side, the producers or the members of the production process would shift the supply of goods to the left. Basically, quantity 1 declines to quantity 2. And notice how the price level is fixed, is sticky. The price doesn't change. There's less supply, and at least in the short term, the price level is sticky. is fixed. It doesn't change. It stays fixed in the short term. This is the short run. In the long run, the price level may adjust. So you move to point B. If there's a lower wage rate, if the wage rate drops, it can shift the supply curve to the right, and you can produce more at a lower wage rate, and Q1 will increase to Q3. And the price level stays fixed, at least in the short term. With lower wages, you produce more. With higher wages, you produce less, and the price stays the same. Or you lay off people. Produce less, higher wages, you produce less in real terms, and you may lay off people in the production process, and the price stays the same. If you lower the wage, you may employ more, and you may produce more, and the price stays the same. So the curve can shift to the right or to the left. The aggregate supply curve is graphically illustrated here by illustrating how it shifts. Lower wages, lower price of non-labor inputs like resources and other raw materials, productivity increases, and beneficial positive supply shocks can increase the aggregate supply curve in the short run. Lower wages, lower non-labor input costs, higher productivity, and greater and positive supply shocks can increase the short-run aggregate supply curve. With higher wages, with higher non-labor input costs, like the cost of resources and raw materials increases, with lower productivities and with lower productivities in the market, and with negatively adverse supply shocks that would decline the aggregate supply curve. And if the aggregate supply curve declines, that's a shift. If the aggregate supply curve increases, that's a shift. Those factors can increase or decrease the aggregate supply of goods and services in the economy. When we bring in the aggregate demand and aggregate supply curves in one graphical illustration, we have the short-run equilibrium model between the aggregate demand of goods and services and the aggregate supply of goods and services. The short-run equilibrium is the condition in the economy when the quantity demanded of real GDP is equivalent to the quantity of aggregate supply in the market. This condition is where both aggregate demand and aggregate short-run supply intersect one another. Aggregate demand by all sectors, consumers, investors, government, and the foreign sector, intersect the short-run aggregate supply, which is affected by wages, resources, non-labor inputs, taxation, government's productivity, intersect one another and meet it specifically in the market for mutual exchanges, and we have an equilibrium price level and an equilibrium real gross domestic product. This is referred to as the actual level of GDP in equilibrium and the normal level of GDP in equilibrium. If the market is in equilibrium in the short term and in the long run, the equilibrium real GDP are both equivalent, and the market is efficient and everything is functioning well. This equilibrium can change, in often cases it can be affected, and if the equilibrium changes, you can end up with a higher price, lower price level, or greater GDP or less GDP. So the idea is to always be within the equilibrium sector, where the short-run aggregate supply intersects the aggregate demand curve, and we have an equilibrium price index and an equilibrium real GDP. Often cases, the aggregate demand can increase or the aggregate supply can shift, and that affects the real GDP of the market. Let's look at what can shift aggregate demand or aggregate supply in various situations. Model 1 indicates here an increase in aggregate demand. So all of this are expressed in the short term. Notice how the aggregate supply curve is the short-run aggregate supply. This is the short-run aggregate demand. In equilibrium, aggregate demand sector meets aggregate supply, and we have an equilibrium price and an equilibrium quantity in real GDP. So in Model A, we have an increase in aggregate demand that has shifted the curve from AD1 to AD2. What can increase this aggregate demand? Consumers may have more income. That increases their consumption, and an increase in consumption increases total spending, and increase in total spending increases aggregate demand. So that's the shift from AD1 to AD2. And in the short term, the price may increase, and here is increasing right away from P1 to P2. But we need, so as we see, an aggregate demand increases from AD1 to AD2, and we have an increase in the price level from point A, P1, to point B, P2, and an increase in quantity real GDP, Q1 to Q2. We have both price level increases, real GDP increases, and aggregate demand increase. The transition mechanism from A to B is actually slightly slower. It takes some time for prices to actually increase right away. But here it's shifting into a new equilibrium level. Model B indicates an increase in the aggregate supply. Short-run aggregate supply has shifted to the right. An increase in the short-run aggregate supply curve here comes from lower wages, a lower wage rate, higher productivity, lower input costs, better government regulations that increases the production of goods, or government subsidies or taxes. So the aggregate supply curve shifts. Notice how it's going away from the origin, so the aggregate supply curve shifts to the right. You produce more, and the price level has a downward pressure from P1 at point A with quantity 1 of real GDP, with a lower price P2 and quantity 2. An increase in the aggregate supply curve leads to lower prices and higher GDP. This arrow, this straight line on top of the aggregate demand curve means that the aggregate demand curve has stayed the same. Now, graph C is indicating that there is a decline in the aggregate supply curve. I know some of the viewers are looking at it and may indicate, well, the supply curve is actually increasing. It's going up. It's going up, and you may actually think that the supply curve is increasing, but no, look at the origin. If the supply curve is shifting left, there is a decline. The supply of goods and services declining is getting closer to zero. And when there is a decline in the aggregate supply of goods and services, and you have the aggregate demand curve there, notice what's happening to the price level. What's going up here is the price level. It's going from point A to point B. We have a higher price, higher equilibrium, with fewer units of real GDP. Aggregate supply curve declines, maybe higher wages, lower productivity, less available resources, or a negative supply shock decreases the aggregate supply curve. We have a higher price level and less GDP. Output declines. There's various reasons why the equilibrium GDP can change within the aggregate demand, aggregate supply model. And those factors can shift simultaneously or can change individually, like here, one by one. Now, if this model 2 indicates an individual shift and a simultaneous shift. Model A is an individual increase in aggregate demand, and Model B is a simultaneous shift on both. So let's analyze these two models separately. In panel A, we have an increase in aggregate demand, a shift in aggregate demand. And again, what creates this shift in aggregate demand? Well, we have aggregate demand 1, aggregate supply 1, equilibrium 1, 125 price level, and 900 units in real GDP. An increase in aggregate demand can come from consumers consuming or spending more, investors investing more, government spending more, or exports increasing. That can increase aggregate demand from AD1 to AD2. That's a shift, it increases. So with more consumption, we have greater consumption, so we buy more units, it increases from 900 to 955. With more investment, we have greater level of real GDP production, so we have from 900 to 955. So we have a new level of GDP, and the price level has an upward pressure from 1 to 2, and it increases from 125 to 130. Again, in real life, the price adjustment process takes some time. If it goes slowly and then it goes up. It doesn't increase right away, but here it is. In panel B, we have a simultaneous increase. We're going to start with equilibrium 1. Equilibrium 1, we have the price level 125. The units consumed in real GDP is 900 units. So we have an increase in aggregate demand and a shift in aggregate supply. Let's look at what's happening here. So a rise in the, let's see, where are we going? We're going from AD1 and aggregate supply curve 1. There is the supply curve, we can start with the Supply curve was shifting to the right. If you notice, the supply curve is shifting to the orange curve. There's a rise in the short-run aggregate supply curve shifting to the right. It's increasing this way. This increase in supply could be coming from a higher productivity. With greater productivity, better input resources, it shifts the supply of goods. And at the same time, simultaneously, we have an increase in aggregate demand, greater investment, greater government spending, greater government spending, greater consumer consumption. So it increases aggregate demand curve, boom, to the right. Where the new aggregate demand curve, which is the red curve, and the new aggregate supply curve, which is the orange curve, intersect, we're going to have the new equilibrium, which is point E2, equilibrium 2. In this case, we happen to have the same price level at 130 and a greater level of GDP at 955. We have an increase in aggregate supply, an increase in aggregate demand. With both of them increasing, we have a new equilibrium price and a new equilibrium real GDP. Sometimes the curves shift simultaneously, sometimes the curves shift individually, but we're looking at the aggregate demand for all goods and services and the aggregate supply of all goods and services leading to, in this case, to a higher GDP level. This GDP is an increase in GDP from the first one to the next. This is so far the short-term changes in aggregate demand and short-term changes in aggregate supply. We need to differentiate between the short run and the long run. The long run is a year, 2 years, and so on. The short run aggregate supply curve is upward sloping. The long run aggregate supply curve is vertical. It's vertical. It's a vertical supply curve. And those supply curves can be adjusted in the long run to indicate a specific level of GDP that is produced in the economy. The following models indicate what would happen if we have a decline in the supply curve. Model A, this model C continuing, shows a decline in the supply curve. The supply curve is decreasing from 955 to 900 units. And that it's increasing. So we're in equilibrium 1 at 125 and 900 units. An increase in the supply of goods, aggregate supply of goods shifts the aggregate supply curve to the right. With a greater supply of goods and services, real GDP increases to 955 and the price level declines to 120 at the new equilibrium of 2. Model D is indicating again a simultaneous shift. We're going to start with point 1. That's the equilibrium 1. In equilibrium 1, we have 900 units and price of 125. The aggregate demand increases to AD2 and the aggregate supply shifts to short run aggregate supply 2. We end up with a new equilibrium where the new aggregate demand curve red and the new aggregate supply curve orange intersect one another, and we have a new equilibrium of 120 and 955 units. There's various reasons why the aggregate demand curve shifts, and those are all listed. Modeling the shifts is important. In the bottom curve, or in the bottom models, it indicates simultaneous shifts of the aggregate demand from AD1 to AD2, and from the short run aggregate supply curve 1 to aggregate supply curve 2, where the shifts are of equal magnitude and the price level doesn't change. It stays the same. The new equilibrium is E1 goes to E2 on the new aggregate demand curve AD2 and on the new aggregate supply curve AS2. So we have a new equilibrium and the level of GDP at 955. All of these GDPs are the same here. From here to here, it will actually help if they were actually different, because you can actually see different models with different prices. But they are all indicating different shifts. Here we have the supply curve that shifts. Here we have a simultaneous shifts with different magnitudes. And here we have a simultaneous shifts with equivalent magnitudes and the price level staying fixed and real GDP changing. When the economy is in long-run equilibrium and in short-term equilibrium together, the model will look like this. The aggregate demand curve indicates the consumption, the investment, the government spending, and the short-term, the exports and imports. And the short-run aggregate supply curve indicates the production of goods and services affected by wages, taxes, inputs, non-labor inputs, government subsidies, and so on. The green curve indicates the long-run aggregate supply curve. If the economy is perfectly in short-run and long-run equilibrium, we have a price level that is in long-term equilibrium, and the actual level of GDP is equal to the natural level of GDP, and the economy is in long-run equilibrium. The natural level of GDP is when the economy is in long-run equilibrium and in short-run equilibrium at the same time, meaning that the economy is operating within its full productive capacities and it's operating in its short-term and long-term capabilities. Is neither over-operating, neither under-operating. We have the long-term capabilities, which is illustrated by the vertical long-run curve, consistently with the short-term capabilities of the market. The long-run equilibrium is the condition that exists when the economy is in capability of producing goods and services in the short term and also in the long run. Wages and prices have adjusted to their final equilibrium levels. They have moved to reach the point of equivalency, and when workers don't have any relevant misperceptions of the production of goods. And graphically, the long-run equilibrium occurs when the aggregate demand curve intersects the long-run aggregate supply curve in the vertical green curve and the short-term aggregate supply curve that is upward sloping. We are in perfect equilibrium at this point. The economy can go through different fluctuations. Sometimes the natural real GDP, which is often referred to as the long-run potential GDP, can be different. It can be less or it can be more. If it's not in equilibrium, then we have underperformance or overperformance in the market. The idea is to always be operating within the natural capabilities of the economy in the short-term and long-term effects. Understanding that aggregate demand consists of all factors that influence economic activity in the market: consumers, business, investors, government, and the foreign sector. And the short-run aggregate supply curve, which are the factors that affect the production of goods and services that can increase or decrease. Great. The economy. A summary of everything in the economy. Summarizing the economic activity. In the short term, we have the aggregate demand that consume goods and services in the economy. And aggregate demand is affected by consumption. Aggregate demand is affected by investment. Aggregate demand is affected by government spending. And aggregate demand is affected by net exports. What is in consumption? Well, your wealth affects your consumption. Your expectation about the futures and your income and prices affect consumption. Interest rates and income taxes affect consumption. Investment is affected by the interest rate, expectation about future activity, and business taxes. Government, we have government policy making, government spending, government development, government projects, and so on that can stimulate aggregate demand. And the net exports are part of the foreign sector, and the exchange rate and imports are also affected by the exchange rate markets. The supply of goods and services is affected by the wage rate, the non-labor inputs, productivity factors, supply shocks that can be beneficial or that can be adverse. When the supply of goods meet in the economy with the aggregate demand of goods and services, we have mutual beneficial exchanges that occur in the economy measured by gross domestic product at a given price level.